Thanks for joining us. I'm Will Woodall. I'm joined by Mike Rarey from CAP STRAT. How you doing, Mike?
Good.
Excited to talk about one of the concepts we really focus on here, which is money supply. Money supply and the growth of money supply has obviously been accelerating at an incredible pace over the last few years, in the last probably 15, 20 years. And it does tell us a lot about the path of markets. So we wanted to share with the viewers how we use money supply, what we think about with money supply, and how we use it to model our investment philosophy and our allocation.
So when we talk about money supply growth, we're talking about this blue line. So this is the year-over-year change in M2. M2 is a broad measure of money. It includes things like bank reserves. It includes things like cash and money market accounts, cash on reserve at the Fed, so on and so forth. So it's a very broad definition of money. And we look at money as sort of the first fundamental or the most important fundamental. Because PE ratios, you don't need those to buy and sell stocks, right? But you do need money.
Yes.
So when there is more money being created, that money generally goes somewhere. But that's the first thing, is money being created. When it's being created at a very dramatic pace, like we saw during COVID, and the economy is shut down, well, that money has to go somewhere. Usually it goes into financial assets.
Right.
And so that's one big reason why during COVID, even though we saw an unprecedented sudden stop economic recession and earnings come down dramatically, it was somewhat easy, because this is a big part of our process, to look through that and think, this is actually the most dramatic increase in the money supply we've seen in history.
Ever, yeah.
And that money has to go somewhere. And so it should be supportive of equities. But now what we're seeing is the opposite. So we model money supply growth. We have a statistical model based on our projections of things like the federal funds rate, bank reserves, the decrease in the Fed's balance sheet, all of these types of things, that now points towards one of the dramatic slowdowns in money supply growth in history, with money supply growth year over year reaching something around 0% by the end of this year. And so, that means the opposite of what a rapid increase in money supply means.
Right. And for the viewers, just explain how we think about the different types of money supply. So we had a lot of fiscal, we've had a lot of monetary. Explain the differences between those two.
Yeah. So in our model, monetary stimulus, it generally comes from two places. One is lowering the federal funds rate. As the Fed lowers the federal funds rate, actually what they're doing is they're going to banks and they're saying, give me treasuries, which are not considered money, and I will give you bank reserves, which are considered money. So that increases the money supply. The other way they do it is by going out and adding to their balance sheet. So buying assets, buying treasuries, buying mortgage-backed securities, and that has a similar effect. The Fed actually doesn't buy treasuries at auction. The banks buy the treasuries.
Right.
The Fed goes to them and says, hey, you give me that treasury, I will give you bank reserves. Once again, taking something that is not money and giving you money for it. So that increases the money supply. So that's how monetary stimulus impacts money supply growth. And then fiscal stimulus, that's primarily through transfer payments, direct transfer payments from the government to individuals. The sort of easiest to understand example of this are the stimulus checks. Right? Stimulus checks basically took money from the Treasury and put it directly in deposit for individuals in bank accounts. And bank account money held in checking accounts and savings accounts, that's money. So that contributes to money supply growth as well.
Money.
Exactly. What you never see is money supply growth go negative. That's almost impossible to destroy money. Once the money's in the system, it gets recycled and recycled and recycled. But what you can see is if we have a big surge in money supply like we had, the year-over-year change of that, it's going to be tough to keep up that pace. So you're going to have a natural slowing. And then if we have things like, okay, we're not going to do more stimulus checks or transfer payments because we've done enough and we're not going to get that passed through Congress. And then we see things like the Fed saying they're going to rapidly raise interest rates while reducing the size of their balance sheet. what you can get is a dramatic slowdown in the money supply.
And so relate the money supply on the next graph to the returns on the S&P 500.
Yeah. So this is what we mean where this is like the fundamental of all fundamentals. Liquidity matters. So if you were monitoring the money supply before 2008, before there was massive central bank intervention, before the Fed was doing quantitative easing, it was like watching paint dry. Money supply chart was not fun. Right. It was not exciting at all. But since 2008, when the Fed became much more active and quantitative easing was more of a tool, the money supply, in our view, has been one of the primary drivers of asset prices.
Yeah.
Not just stocks, but bonds as well. Because you're just creating a lot of money and the money has to go somewhere. So these lines lay pretty much right on top of each other. You have the money supply in blue and then the S&P 500 index in green. And, there's still a lot of debate between causation or correlation here. But in our view, when you create money and the central bank is buying assets and you're giving people money, what happens is interest rates get lower. There's more liquidity in the system. It's easier for companies to issue debt. It's easier for companies to use that debt to buy back stock. As you buy back stock, you increase your earnings per share because you reduce your share count. There are many ways. This is the wealth effect in effect, basically, is how we view it. So a dramatic slowdown in the pace of money supply growth is not a good thing in terms of our outlook for all asset prices, particularly equities.
And so you could probably overlay all the asset classes on this line, and there would be a correlation to that. To it, even like home prices, all those assets. Talk about so if we look at just the tip here where we are now, we've seen a downturn in the market. The money supply, as we're saying, is rolling over. We're forecasting is rolling over. How does that impact? How does that play out in terms of economic growth, inflation? Like maybe that's part one. Part two is why haven't we seen inflation until now, given this money supply growth?
Yeah. So when money is created, if that money is not used for economic purposes, meaning it's used for low velocity uses, is the wonky term we would put into it. So for example, if $1 is created and it's put in my bank account and I just use it to pay down debt, that does not contribute to financial asset prices. It does not contribute to GDP at all. That's a zero velocity use of money. So that's a lot of what happened post-global financial crisis. The money was created, but it was a balance sheet recession. So everybody used it to repair their balance sheets, pay down debt. Banks, for example, used it to recapitalize the entire banking system. Those are extremely low velocity uses of money. So what you don't get is a big boom in economic growth. Eventually, once balance sheets are repaired, but people don't want to take on more debt, they still don't want to spend money in the economy, it starts to support asset prices because the money's got to go somewhere, right? So risk appetite grows and grows and grows. And you saw this play out again during COVID.
This shows asset prices.
Exactly.
Clearly.
Yeah, I mean, when the money's created and you can't spend it in the economy, where is it going to go? So it goes into asset prices and paying down debt and all those types of things. So now when we're forecasting the growth in the money supply is going to slow dramatically, why are we forecasting that? Well, because we don't think there's going to be another round of significant stimulus checks. In fact, fiscal spending is going to weigh on growth this year. And then on the monetary side, the Fed is going to it looks like they're going to embark on an extremely aggressive rate hike cycle and reducing the size of their balance sheet. These are the reasons why the market has been selling off year to date, and then you add on Russia-Ukraine situation. So, the market is also forecasting a slowdown in money supply growth. What seems to be underappreciated is at the end of the year, we could be at the lowest year-over-year change in money supply growth in history. Last time we were even close to this was sort of late 90s. And that obviously had negative consequences later on in terms of tech bubble burst and things like that.
And maybe part two of my question, why are we only seeing inflation sort of now?
Yeah. So when the money was created during COVID, the first place it went was to shore up balance sheets and into asset prices. Then we tried to reopen the economy almost as aggressively as we shut it down. And so a lot of that money, as it was still being created, then had a place to go. And inflation is always and everywhere a monetary phenomenon. So we had created more money since COVID than at any other point in history.
Mm-hmm.
About a third of all US dollars in existence were created since March 2020. So that's the first thing. The money's got to go somewhere. And then you have this big confluence of supply and demand factors. So we shut down the economy. There is no supply. There's no productive capacity. And then we try to reopen it. Everybody has money to spend, but we can't meet that demand with adequate supply. And so as we reopened, clearly you get a surge. You have a demand shock combined with a supply shock that followed a monetary shock. And those three factors coming together, you get the highest inflation in 40 years. Easy to say with 2020 hindsight,
sure.
Right?
Yeah, absolutely. Yeah. And so how does the significant rate of change in money supply impact sort of the near-term growth estimates and asset prices?
Yeah. So once again, going back to money is the ultimate fundamental. It's what you use to buy anything. If you are reducing the supply of money or you're slowing the supply of money, you are naturally going to reduce demand. Mm-hmm. Where is your next marginal buyer of assets going to come from? Where is your next marginal buyer of goods going to come from? And then you think about the factors that are resulting in this slowdown in money supply. Well, they are not going to be good for growth. I mean, obviously, fiscal spending year over year is going to be a drag on growth. Mm-hmm. That's baked in the cake. And then the Fed hiking interest rates and reducing the size of the balance sheet, that is only to slow growth. That is the entire purpose of that policy tool, to slow growth, tighten financial conditions so that demand can decrease and allow inflation to come down. So, I mean, it's not good for asset prices first, and then it's probably not good for growth next. And then it's probably not good for inflation, which you would say, well, inflation coming down is good. So it's good for inflation coming down later.
Right. So we're already starting to see the beginnings of the effect on asset prices. Mm-hmm. So we would see the impact on growth immediately, 2 quarters, 3 quarters. How does that play out?
So there's definitely a lag. There's a lag with monetary policy. When the Fed hikes interest rates, usually you don't start to feel the negative growth impact of those interest rate hikes for anywhere from 6 to 12 months.
Right.
If they hike aggressively, you'll feel it sooner. Mm-hmm. If they're hiking aggressively as the growth is naturally going to slow anyway, you'll feel it even quicker. So, I mean, it's tough to say, but you look at full year growth estimates for 2022 at somewhere around 3%, and you factor in how aggressive the Fed is going to be now, basically get almost their entire rate hike cycle in this year, and you would say, well, the risk is to the downside on those growth estimates, mm-hmm. for sure. So would not be surprised if this starts to bite in terms of growth and inflation as we get into Q3, Q4, possibly already start to see signs of it in Q2.
Yeah, it certainly is an important factor, and I think it's relatively overlooked in a lot of models. And we keep tabs on this regularly. So folks, if you want to talk through this, look at our projections, see how we model this. We'll have another video specifically going into how we model money supply. So we'll look forward to sharing that with you. And in the meantime, thanks for joining us and look forward to our next video.